Good afternoon, David Drozdowski with Union Home Mortgage. I've had some questions and I've seen a lot of news articles about this, so I figured I'd cover it. Questions about why do buyers with higher credit scores have to pay more than a buyer or borrower with a lower credit score? So I made a quick slideshow. I'm going to go through it and just cover hopefully some of these questions. So the Federal Housing Finance Agency, they have set the policy for mortgage pricing. It's kind of industry standard. And just will those with higher credit scores pay for those with lower credit scores, or what the heck is an LLPA? I'm going to get into that. Here is loan level price adjustments. So when we look at interest rates, what is the rate? And then based on credit score and loan to value, that rate is being adjusted with loan level price adjustments, either up or down. You can see in this example, somebody with a 640 credit score, 80% loan to value, they're going to get hit with loan level price adjustments of 2.25 points. That is an adjustment to the price on their interest rate. This is something that not many people see, but this is the change. So let's look at somebody with a 740 credit score. Based on their credit score, they're going to get less of an adjustment to their price. Really what we're talking about is points, or how this affects the interest rate that they're offered. Okay, so the 640 credit score with this new guide, they're going to pay 1.375 points higher than the 740 credit score. On a $300,000 mortgage amount, that's basically $4,125 in points or fee than the person with the higher score. However, this change, now back to the person with the lower score, is still lesser than they would have previously paid. It's $3,375 lesser than the previous pricing, or overall 2.5 points lesser than the previous pricing. So that's what a loan level price adjustment is. This is the news article that actually came out yesterday from the director of the Federal Housing and Finance Administration. I'll put a link to this article in the comments. Why the changes? Since 2008, the enterprises, we're really talking about Fannie Mae, Freddie Mac, the biggest mortgage houses, they have been backstopped by taxpayers. These changes are to essentially realign the profitability of Fannie Mae and Freddie Mac and not have to rely heavily on this taxpayer backstop. All right. So profitability, number one. They've made these changes to price adjustments to help first-time home buyers and lower incomes. They say in their announcement they still want to make sure that they're credit worthy, and they still want to make sure that they have the financial capacity to repay. They also have made these changes up as well as down to attract more investors across the globe to purchase our US mortgage-backed securities. Here is the most simplistic breakdown that I can give. Red is rising cost for borrowers with changes. Green is falling cost. And you can see this is a mix. We have some rising cost for lower credit score, higher loan to value in this column. You can see this blend where now we've spread the cost to some of the higher credit score, but still same loan to value category. They're still paying something for basically the risk of their loan. You can see in some categories, lower credit scores, yes, some significant changes, but really we're talking about low loan to value. I hope this helps. I'll put the link to the two most pertinent articles in the comments. If I can help you, if you have any questions about mortgages, if you have questions about these changes, feel free to call me, 352-895-4799. David with Union Home Mortgage. Thank you. Have a great day.